Today, you're going to hear 3 key parts, especially if you're a DBS shareholder or if you're intending to buy DBS shares. The first that you'll be hearing is the dividends that are being announced. What exactly is it and what is this bonus shares that you will be getting? The second, I'll be sharing with you big picture wise whether this dividend is sustainable or not for 2024. And last but not least, I'll share with you latest results, what is also good from inside, and my personal conclusions. So if you're keen, continue watching. Hi guys, welcome back. Without further ado, let's start with the first part, which is this dividend announcement by DBS. At current share price around $33, a $1.92 dividends is almost 5.9% in terms of dividend yield. Wow, that's actually above some REITs, correct? And this of course is our bluest or blue chip in Singapore. Now there's something to note also. DBS has actually inched up its dividends from $1.50 last year to this record $1.92. So that, as you can see, is a 42 cents jump in a whole year basis, which is equivalent to 28% growth. As always, if dividends can grow by 28% year on year, then this thing will become to the moon already. But that's why you're here, correct? You can likely guess that 28% year on year growth is likely not sustainable, which is what I'll explain through the remaining of this video. The second interesting part, which you may have questions, are these red columns over here. Let me explain to you what exactly is this 1 for 10 bonus share. It actually means that if you have 1,000 of DBS shares, in this coming dividends X date, you'll also be given 100 more shares. You don't need to pay for the shares, but also you do not naturally benefit that much also, other than DBS being more liquid than ever. This whole exercise is akin to a stock split only. So let me explain to you in terms of numbers. Right now, DBS shares could be around $33, and if you have 1,000 shares, it's worth $33,000, correct? After the dividends are given, with this bonus, it just means that you have 1,100 shares instead of 1,000, and the share price will naturally adjust to $30. $33 times 1,000 shares equals to $30 times 1,100 shares. There's no increment to your net value. It is again just like a stock split only. And this extra shares that you'll be getting if you are a shareholder is also not entitled to the fourth quarter 2023 54 cents of dividends. It will only be entitled to 2024 onwards dividends. And what the right hand side diagram is trying to show you is that if we annualize, that means 4 times 54 cents, that means 216 cents will be a yearly dividend. If DBS is able to maintain this $2.16 per share, this bonus unit will be equivalent to a 24% increment in terms of dividends to you as a shareholder. Again, the caveat is if DBS is able to maintain an annualized of $2.16 dividends per share. Still, that seems like good news on the surface. But why exactly is DBS shares not skyrocketing as you can see over here? DBS shares have been roughly flat to downwards, correct, over the last 1 year. And personally to me, it seems like a bit of a surprise that DBS did not make an all-time high in 2023 when we realized interest rates could stay high for the year. I'll come back to this point in a while, and as always, if you have learned something already, help me smash the like button early, or if you have a friend who has a DBS shares and has questions about it, share this video with them. This share price performance may be explained by this second part, which is this dividend sustainable for 2024 and beyond? To answer that question, let's recap again how DBS or any bank actually makes money. You know, when you make a 18-month fixed deposit to a bank, you put your $100 there for 3%, that actually is a loan to the bank, correct? And what does the bank do? They turn it around and they lend to corporates and individuals at, for example, 6% of interest. So there's something called net interest margin, which is net interest income over the earnings assets. Net interest income, which is actually interest income that they earn from the 6% loan, minus away interest expense that they pay to you as a fixed depositor. So net interest margin is what they do when they borrow from you and lend to someone else. Pertaining to this point, I realize that many people are unaware that this rapid growth in profitability has a bit of seasonality to it also. What we saw in 2022 to 2023, general interest rates spiked up, correct? Which means the banks, when they lend out Previously to corporates, it was 4%, they became 5% and then 6%. Interest income naturally for them spiked up. But what do we realize? Interest expense, which is paid to fixed depositors, for example, did not really climb as fast. There is a lagging factor. And the question is why, correct? Now imagine this. If you had made a 18-month fixed deposit, you were someone who put your monies in their fixed deposit for 18 months back in August 2022. What kind of interest rates were you rewarded back then? The answer is actually not 3%, which is today's rate. The answer is actually about 1% because that was the interest environment back then. You would realize the DBS has actually a portion of its books from people who have lent them money at a very cheap rate just 2 years back. But they are now lending people at today's rate, which is much higher. That explains why the net interest margin will actually expand out when the interest climate spiked up rapidly in the last 1 year plus. That was not only experienced by DBS, that was also experienced in OCBC and UOB, and as well as many other banks around the world. This rapid interest rate spike became a blessing to their profitability, which in the short term would pick up at some point. That picking point could very well have passed already. Because if you see in terms of profitability, in this chart, it will show you that DBS has almost doubled in 2023 its profit levels as compared to 2021. This entire year-on-year growth of 20+% has a lot attributable to this net interest margin fattening up. So far, the consensus is general interest rates might drop a bit in 2024. If interest rates drop, the fattening of margins would reverse, correct, to a shrinking of margins. What goes up must come down. So let's hear what CEO has to say about his expectations of Fed interest rates.
We are assuming 5 rate cuts, but starting only in the June-July timeframe. If NIM drops more because rate cuts start earlier or are sharper, it's not my base case, but if that happens, I think there will be swings and roundabouts. I think we'll make it up through a little bit more pickup on loan growth, if that's what happens. Right now, our loan growth assumption is also low single digit. But if rates come up more sharper, I think loan growth could make that up.
Now, no one knows for sure, even CEO of DBS, of what would Fed do. I guess they don't know themselves also. But DBS has also mentioned that they have prepared for lower interest rates in 2024 by sacrificing some margins already in third quarter 2023 and fourth quarter 2023. If we see in terms of net interest margin, the peak was very clearly in third quarter 2023 where they clocked a NIM of 2.82. Fourth quarter 2023 has already seen a dip to 2.75. Listening into the presentation, they did mention that first quarter 2024 looks roughly the same as fourth quarter 2023. Nothing is dropping much yet, and they expect it to be flat. Now that seems good, but to me also, the peak in third quarter 2023 is getting pretty obvious already, which could be the reason why share price is flat to down. Share price is always forecasting 1 year into the future. Maybe Mr. Market is voting that profits not only stay flat, but might also shrink a little bit. Whether that's true or not, let's stay tuned and find out together. So as always, make sure to subscribe so that when there's new release, new updates, I'll share them with you right here on this channel. Now to round things off, let's go to the third segment for today, which is what are other good parts about its latest results that you should know, as well as my conclusions to share with you. DBS has actually acquired Citi Taiwan in August 2023. That mega acquisition has led to customer growth and has also led to fee income growth, which was already experienced in third quarter 2023 and fourth quarter 2023. Total fee income is expected to be double-digit growth for 2024, and the main areas are wealth management growth as well as card transaction growth. As long as interest rates don't come tumbling down too fast, it is very likely that this growth could offset the drop in net interest income. The other thing also mentioned is that COO has actually taken a pay cut together with senior management, and his pay cut was a deep 30%, costing $4.14 million. Top management took the pay cut. Junior employees, on the other hand, enjoy a 1-month bonus, which in my opinion seems very fair for equality. And the reason why senior management had to take a pay cut for performance is because DBS has actually experienced a bad one-day outage back in March 2023. If you remember back then, DBS Online went down, PayLah went down, etc. etc. A lot of consumers were very angry, and MAS has actually imposed a 6-month pause on their non-essential activities to punish them to focus on system resilience. In my opinion, that is almost now in rear view already, and management taking accountability to me is definitely a plus point. But why do I have my conclusions as you see in the thumbnail over there? Well, it's not that DBS is more expensive on a price to book ratio than UOB or OCBC. If you see over here, DBS right now is at 1.41 times price to book ratio, above the sector average of 1.22 times. UOB and OCBC are around 1.1 times. I guess that premium is justifiable because DBS is a top franchise. But if you were to piece share price performance of DBS and UOB and OCBC together, you would realize that they've been trending downwards together. Not just that, Citigroup has also announced laying off of staff. HDFC, which is India's biggest bank, had also an earnings disappointment. I think the overall banking sector as a whole for 2024 could be a down year. That is why also I think if earnings slightly disappoint, can't reach that 10 billion mark that was done in 2023, there is a small chance that DBS stock could drop below the $30 range. And that's why I'm not in a hurry to buy DBS shares. Again, that's not investment advice. If you're a long-term shareholder, these are just cyclical ups and downs. It's much better to stay invested and watch out for growth in 2025. Let me know if you agree with me in the comment sections below, and thank you for watching right at the very end. With that, I invite you to this previous video I have that links to this, and maybe you can learn a thing or two further about investing. With that, sign off from me and see you there. Take care as always. Goodbye.